Good morning. Accelerated depreciation in commercial real estate and timing your taxes like a pro. And if you're investing in commercial real estate, not leveraging accelerated depreciation, you're leaving money on the table, is the point. And this isn't a loophole, it's a timing strategy. And when it's used correctly, it can significantly improve your cash flow, increase your reinvestment capacity, or enhance your long term returns. So let's break that down for you. Well, what is accelerated depreciation? Accelerated depreciation allows investors to front load tax deductions instead of spreading them out evenly over decades. And understanding that standard IRS rule, or under the standard IRS rules, commercial property generally has a 39-year depreciation schedule, whereas a residential is about 27 and a half years. And that's predictable, but it's slow. And accelerated depreciation basically shifts those deductions into the early years where they matter the most. It helps cash flow, it helps debt service coverage, and it helps reinvestment into new deals because you're getting an after-tax benefit. Bottom line there is you're not eliminating taxes, you're just repositioning them in time. So, two primary strategies is Section 179, or targeted and controlled request. And that's best for, say, equipment or tenant improvements or specific asset components. And key characteristics there could be deductions limited by taxable income, or you cannot create a large enough loss, right? And it's ideal for owner users or stable income scenarios. So think of this as a scalpel: precise, controlled, and strategic. Precise, controlled, and strategic. Say that 3 times fast. 2, bonus depreciation: aggressive and powerful. Best for, say, acquisitions or value add deals, and particularly useful when paired with a cost segregation study. And some key characteristics there is there's no income limitation, and it can create large paper losses, and often used in year 1 of ownership. So this is the sledgehammer. It's a massive upfront deduction that can transform deals and their economics. So next segment is where most investors get it wrong. And here's the part that nobody really talks about. You don't benefit from depreciation unless you can actually use the losses. So this is where passive activity rules can come into play. And the problem is that losses may be suspended if you don't have sufficient passive income. So you may not qualify as a real estate professional, and then the benefit becomes delayed instead of an immediate one. And the result is you've created complexity, but you didn't improve current cash flow. So the strategic play here is to match depreciation to your income. And sophisticated investors don't just take depreciation, they align it with their tax profile and capital strategy. So let's talk about some smart use cases. There's high income earners, say doctors or business owners, and those can use bonus depreciation to offset active or passive income with the proper structuring. Great for portfolio investors who pair depreciation with the existing passive income streams from their properties. And value add investors combine cost segregation plus bonus depreciation to increase the early IRR of the project. And why this matters in today's market? Well, in a higher rate environment, debt costs are up and cash flow is tighter. And a refinance risk it's a real concern right now. And accelerated depreciation becomes a cash flow stabilizer for you. So it can improve your DSCR indirectly via retained cash that are for after-tax benefits, and increase liquidity, which allows faster reinvestment into new deals. And the real advantage is capital velocity. And this is where elite investors separate themselves. And accelerated depreciation isn't about saving on taxes. It's about recycling capital faster. And more retained cash equals more acquisitions. It means more leverage opportunities. And it also means more portfolio growth. So the final takeaway today is that accelerated depreciation is one of the most powerful tools in commercial real estate, but only if used strategically. And when used correctly, it boosts early cash flow, it enhances returns, and it increases deal scalability. Whereas if it's used blindly, it creates suspended losses and adds complexity to something that doesn't need it, but it also delays benefits. And the point is that structure beats strategy, and strategy beats taxes. That, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com, to get a hold of me. Love to talk to you more. Take care.